Hello and welcome to yet another edition of What the World Wants from India. Ahead of the budget and the general elections, we speak with leading global market masters about how they are approaching India ahead of these two crucial events. Of course, we also try to glean the global context in which the Indian economy and Indian earnings will be viewed by these investors. On the show today, we will be speaking to Venkatesh Sanjeevi, Senior Investment Manager and a long-time observer of Indian equities at Pictet Indian Equities. That's in just a bit, but joining us right now is Executive Director and Global Strategist of Goldman Sachs Caesar Maasry. Caesar, thank you very much for joining us. Well, first up, how are you looking at first the global equities this year? I'm asking you because the markets are playing out in the context of contracting liquidity. Liquidity is tightening with at least two major central banks clearly indicating that they are going to contract their balance sheets. How does that set the stage for global equities?
The outlook for global equities looking into 2019 is contextualized by the phrase, it's late in the cycle, but the cycle is not over. I think there are concerns about liquidity, but really that information was processed sort of last year. That is, the signaling from central banks that monetary policy might be tightening going forward. If we actually look at the last couple of months, interest rates have, of course, come back down, and so I think those concerns are a little bit less important than really the fundamental ones about global growth. That is certainly the most important issue for equities in general, and as we look out into 2019. And our views on global growth, I think, are a little bit more constructive.
Well, so do you think you're going to see emerging markets overtake or even do better than developed markets? Will smart money chase emerging markets now?
So I think that's a key question, of course, is the allocation across regions. And we actually don't see it as clear-cut as that at sort of the regional context. I think, again, 2019 should be contextualized by the word convergence, basically the U.S. catching down to the rest of the world. So that probably presents some outperformance opportunities for the international equity frontier with respect of the investors sitting here in the United States. But also I think emerging markets will not necessarily trade sort of homogenously or as one big asset class. I think there's many opportunities in individual countries. For example, Brazil, Mexico, and South Africa are sort of high-yielding EMs where I think there's quite a number of opportunities idiosyncratically.
Well, I noticed you did not say China. What's your view on Chinese growth itself? Will it recover if there is a trade truce?
We actually are relatively optimistic on China. I think there's a lot of uncertainty around the outcomes because there are a number of issues. But if we start with growth, again, I think the long-term story in China over the last several years has been sort of a bumpy slowdown in their growth trajectory. We expect that to continue, but we still think growth will remain above 6%. I think the headline risk of trade tensions certainly, again, was a big story of last year, and that seems to be improving in the last few months. Again, we have a March 1st deadline. Our house view is we're not sure there will be real progress between now and then, but as we look over the course of the year, we do see progress on the sort of negotiation front. But I think, again, importantly, the thing to keep in mind is valuations in Chinese equities are actually quite low relative to the recent history, and so we do see upside potential there.
Well, Wilbur Ross has said that China and US are miles away from an agreement, and yet the converse also was mentioned by Mnuchin. Apple also threw a kind of a scare about the demand for their products in China. All that seems to be pointing to a lot of slowdown. You don't believe so?
I think you have seen a slowdown, and while I wouldn't comment on individual statements, I think if you do look at the process of trade negotiations, we have seen positive signs over the last several months. And again, if we speak about markets, keep in mind the renminbi has already depreciated something like 10% over the last 12 months. So that should already cushion the blow of tariffs vis-a-vis the growth impact. Now, again, this is just one issue. The other major issue about Chinese growth is domestic policy. So it's been very clear that Chinese policymakers have been easing monetary conditions through lower interest rates, through trying to provide liquidity to the local banks, and perhaps a little bit more stimulus on the fiscal side. I think those things tend to signal potential stabilization or even improvement in growth, again, over the next few quarters.
You know, India did not figure in your pecking order of emerging markets. What worries you about India?
First and foremost would be the valuation. I don't think there are clear signs of deterioration in the fundamental outlook for India. But keep in mind, we're trading at about 18 times forward earnings in Indian equities. And relative to the rest of the EM sort of equity index, you're trading at about a 70% PE premium. That's really towards the highest we've seen over the last 10 years. So for us, it's less about near-term concerns with the fundamentals in India. It's more about that entry point we think is still a little bit stretched. That being said, we have India as a neutral, so we think it's a core position of any emerging market portfolio, and we would sort of look for a better entry point.
So is it only earnings and valuations that worry you? There is also a general election looming. Is that a bother?
I think all elections tend to be headline risks. And of course, we have an important election in India in the next couple of months. But let's think about last year, for example. You had elections in Chile, in Brazil, in Mexico. And in many of these places, if you even knew the outcome of the election before it happened, you may not have traded the market correctly. And so I think we sometimes focus a bit too much on politics simply because we know it's going to be a headline. We know that there's a catalyst, but it's not always clear how that will affect the fundamental picture. I'd also say separately, our credit team in Asia just published a report today looking at how India specifically and Indonesia separately trade around elections, and they still find that during those times the markets tend to trade sort of global fundamentals, global macro variables, more so than the individual election.
Caesar, there's yet another worry that some foreign investors keep speaking about. Ahead of the elections, there is a budget that's coming up on February 1st, and it's expected to be a typical pre-poll budget with a lot of large promises to farmers. Some people fear that might increase the fiscal deficit next year. Is that particularly worrisome for you?
In general, fiscal deficits are becoming a problem, or I should say an increasing problem in general. When you get late cycle and debt dynamics look unsustainable across the globe, I think this is a problem. In India's case, I think it's maybe a little less so, firstly because India is not the only one with a decent-sized fiscal deficit, but also I think second derivatives matter here. And so if you actually look at the Indian fiscal, at least at the central government level, we were running something like a 6% fiscal deficit several years ago. That's improved somewhat with the acceleration in growth. So I still think the second derivative has been largely positive for India, and I don't think the fiscal deficit, while it is a long-term concern, is really what the market will be focused on in the next few months.
We've recently had the Reserve Bank governor resigning on some principles because the Reserve Bank's capital was going to be used by the government. And now a committee is, of course, deciding how much capital the central bank needs to have. But more generally, would you fear that you could have a very dovish Reserve Bank?
The institutional quality across EM and in India specifically has been improving and is actually quite strong in general. And I think that's important to keep in mind. I think in India's case specifically, we've actually shifted our view where we think the RBI can be a little bit dovish in the near term, and that's okay because actually inflationary pressures have subsided. Oil prices have come back down after the sharp rise sort of in the fourth quarter last year. Again, global interest rates have come back down, and pressure on the currency has subsided. So I wouldn't read so much into near-term dovishness as an institutional issue. I think the global macro environment allows them to be so.
Some people are able to swallow India's high valuations because right now crude prices are lower as well. Now, India typically grows faster and the growth rate is expected to be above 7%. You don't think that these are reasons enough to stomach high valuations and still buy India?
From a long-term investment perspective, right, you can make money by being long Indian equities. All I would say is when we look within the emerging market equity universe heading into this year, there are other places that have been beaten down a little bit harder. So that would be reflected in lower valuations. But then the other thing, again, I use this term several times, the second derivative is quite important. I think there are other economies that have a better chance of really surprising to the upside in terms of growth. I think India will be very stable, and in a way it's insulated from some of the risks we discussed about trade tensions and so on. So perhaps it's a decent Sharpe ratio trade. But if you're really looking for strong upside, I just think there's some better opportunities in the near term elsewhere.
So do you expect crude to remain subdued? Because, it's a very important variable for India.
We see a little bit near-term upside in crude prices from here, about 5 to 8% over the next 3 to 6 months. Part of that is concurrent, again, with some stabilization in global growth. But actually, over the medium term, we're not as bullish, and we see oil prices, at least on Brent, basically remaining in the low 60s. So again, I think that paves the way for India to manage the course this year. We have a rupee forecast of 71 versus the dollar. So again, I think for the international investor, that provides a decent carry opportunity. And again, we didn't really discuss fixed income, but India local bonds, sort of 10-year government bonds, trading at 7.5%, actually also looks like a pretty decent opportunity for the international investor.
Caesar Maasry, on that note, thank you very much indeed for joining us with the global context as you see it, the role of emerging markets and how you view India and Indian valuations. We have to take a break, but up next, Venkatesh Sanjeevi, the Senior Investment Manager, Pictet Indian Equities, is joining in.